Most people talk about crypto as if it's one thing. Bitcoin goes up. Crypto is doing well. Bitcoin crashes. Crypto is dead. But here's the problem with that framing. Bitcoin and the thousands of other cryptocurrencies that exist are not the same thing. Not even close. Bitcoin has recovered from every major crash in its history. Most altcoins have not. In fact, according to CoinGecko, more than half of all cryptocurrencies that have ever been listed, over 13 million tokens, have already failed and disappeared. That's not a rough patch. That's the default outcome. And yet, when most people say, "I want to invest in crypto," they don't mean Bitcoin. They mean the coins they heard about at a party. The ones with the flashy website and the 10,000% promise. And that distinction between Bitcoin and everything else is the most important thing nobody teaches you before you put your money in. Think about how people actually discover altcoins. Someone mentions it in a group chat. A YouTube channel does a deep dive. A coworker says they tripled their money last month. And you look it up. The website looks professional. There's a white paper, a roadmap, a team with LinkedIn profiles. It looks like a real business. The coin is trading at 12 cents, and the pitch is that it's going to be the next Ethereum. You do the math. If it gets to even $1, that's more than 8 times your money. You buy some. Here is where the story almost always goes wrong. Not because you were foolish, but because the tools you instinctively use to evaluate that investment, the website, the roadmap, the community excitement, are not the same as understanding what the coin is actually worth. And for most altcoins, nobody actually knows what they're worth. Not the team, not the analysts, not the investors who've held them for years. The absence of a real valuation framework is not a temporary gap waiting to be filled. It is the defining structural problem of the altcoin market. Here is what most people don't realize until it's too late. Bitcoin and altcoins are fundamentally different types of assets. Bitcoin has been around since 2009. It has survived multiple crashes, multiple regulatory crises, multiple attempts to replace it. It now has institutional backing, ETF products, and a track record no other cryptocurrency has. None of that means it's risk-free. But it does mean it operates with a different set of rules than a coin that launched 6 months ago with a celebrity endorsement. For altcoins specifically, the question isn't just how to value them, it's whether valuation is even possible at all. And the evidence of what happens when that question goes unanswered is written in billions of dollars of destroyed wealth. Consider Zoe. Zoe is 28 years old. She lives in Nashville, Tennessee, and works as a graphic designer. In early 2021, she put $500 into Bitcoin, watched it double, then watched it fall back. She still had her $500 worth, more or less. Then her friend told her about a DeFi project launching on a blockchain called Terra. It had a stablecoin called UST that was pegged to the dollar, which sounded safe. And it had a companion token called Luna that had been climbing for months. More importantly, there was a lending platform called Anchor that was offering 20% annual yield on UST deposits. 20%. In a world where a savings account pays less than 1%, that number is almost impossible to walk away from. Zoe put in $1,000. She wasn't greedy, she wasn't reckless. She just saw a number that made financial sense to her. What she didn't know, what almost nobody properly explained, was that the 20% yield was not generated by real economic activity. It was being subsidized from a reserve fund that was quietly running out of money. The entire architecture of the Terra ecosystem depended on an endless cycle of new money coming in to pay the people already inside. In May 2022, that cycle broke. UST lost its dollar peg. Luna, which was supposed to stabilize UST through an algorithmic mechanism, began to hyperinflate. Within 4 days, Luna went from $90 to less than 1 cent. Terra erased roughly $60 billion in value. Zoe lost everything she'd put in. And she was not unusual. A factory worker in Chicago told Al Jazeera he lost $40,000, everything he had in savings. A Reddit post read, "I lost my life savings. I got greedy hoping to get enough for a down payment on a house for my family." Terra was not a fringe coin run from a garage. It was ranked in the top 10 most valuable cryptocurrencies on Earth the week before it collapsed. Here is the first hidden rule. Bitcoin and altcoins are not the same asset class. They share a name, they share a market, but they operate on completely different foundations. Bitcoin has one thing no other cryptocurrency has ever achieved: 16 years of network survival. Every attempt to hack it, ban it, or replace it has failed. Its supply is fixed at 21 million coins, not as a promise, but as a mathematical rule nobody controls. That doesn't make it a perfect investment. But it does make it fundamentally different from a coin launched in 2021 by an anonymous team with a 9-page white paper. Here's the data that makes this vivid. Bitcoin dominance, the percentage of the total crypto market that Bitcoin represents, has been climbing steadily since the FTX collapse in 2022. By early 2025, Bitcoin dominance had risen above 60%. That number means something specific. For every dollar flowing into the crypto market, more than 60 cents was going into Bitcoin. The rest was split among thousands of other projects. And as institutional money entered through Bitcoin ETFs in 2024, more than $56 billion in net inflows, that money did not rotate into altcoins. It stayed in Bitcoin. The market was telling you something. The most sophisticated money in the world was making a clear distinction between Bitcoin and everything else. The second hidden rule is about what it actually takes to value an altcoin. When you buy a stock, the process is imperfect but coherent. You look at what the company earns. You project how fast those earnings will grow. You compare it to similar companies. You end up with a number you can argue about. For Bitcoin, valuation is hard, but not impossible. You can analyze its network usage, its scarcity mechanics, its role as a store of value. The CFA Institute, the body that certifies professional investment analysts, published a guide specifically for this in 2023. It listed 4 separate models. None of them agreed, but at least the frameworks existed. For most altcoins, there is no framework, not even a contested one. What drives altcoin prices? Mostly 3 things: hype cycles, token unlocks, and liquidity. Hype cycles are self-explanatory. The coin gets mentioned by an influencer. Demand spikes, price goes up. Token unlocks are more dangerous. Most altcoin projects distribute tokens to their founders and early investors on a vesting schedule. When those lockups expire, large holders can sell. The retail buyer, you, often has no idea when this happens or how many tokens are about to flood the market. And liquidity is the hidden trap. Many altcoins have very low trading volumes. That means a relatively small amount of selling pressure can cause a price to collapse overnight. You bought in at a price that felt real, but that price was only real because there was buying pressure holding it there. The moment that pressure disappears, the price discovers what it was always actually worth, which for most altcoins is close to nothing. CoinGecko research found that as of the end of 2025, more than 53% of all cryptocurrencies ever listed had already failed. Over 13 million tokens, gone. Not recovered, not restructured, just gone. Here is something that doesn't get talked about enough. The altcoin market is not a market in the traditional sense. In traditional markets, there is a mechanism that, over time, pulls prices toward value. A stock that earns money will eventually attract buyers based on those earnings. A stock that earns nothing will eventually find sellers who are tired of waiting. The mechanism is imperfect. Bubbles form, bubbles burst. But there is an anchor. In the altcoin market, that anchor is usually absent. Price is driven almost entirely by narrative, and narrative is controlled by whoever has the largest platform and the most tokens to sell. This creates an asymmetry most retail investors never recognize. The people who launch altcoins, the founders, the early venture investors, the influencers paid to promote them, typically hold the largest positions. They bought in before you did, at a tiny fraction of the price you paid. When the price rises on retail excitement, those early holders have every incentive to sell, and they do. This is not a conspiracy theory. It is the standard business model of the altcoin market. Retail investors provide the exit liquidity for insiders. The mechanism is so consistent that a market analyst described it plainly. In any other market, a project offering zero rights and total treasury opacity wouldn't raise a dime. In crypto, it was the only compliant way to launch. Look at the data from any altcoin bull run. The coins that perform best during the first phase of a rally are always the ones with the most aggressive marketing. The coins that are still standing 18 months later are almost always Bitcoin, and a very short list of others. The 2021 bull run produced hundreds of altcoins with billion-dollar valuations. By 2025, altcoin trading volume on major exchanges had collapsed by 80 to 85% from its peak. The excitement vanished. The money was gone. Here is the uncomfortable truth. The reason most people lose money in altcoins is not because they were uninformed. It's because they were asking the wrong question. The question they were asking was, which coin is going to go up? The question they should have been asking was, does this coin have any reason to exist in 5 years? That second question is much harder to answer, because most altcoins don't have a clear answer. They have a use case that sounds compelling in a white paper. They have a community that believes in the vision. But they lack the one thing that separates a real financial asset from a speculative token, a reason why its price should be connected to something real. Here's what Zoe eventually understood. She had confused sophistication with safety. Terra looked sophisticated. It had academic partnerships, a major sports sponsorship, a complex algorithm, and billions in deposits. Sophistication is not safety. A complex mechanism that doesn't work is still a mechanism that doesn't work. What she had actually been doing, without knowing it, was lending money at 20% interest to a system that had no sustainable source of 20% returns. That sentence describes not a crypto problem, but a universal financial problem. If the yield is dramatically higher than any comparable market, someone is either taking a risk you don't understand, or being paid from capital that will eventually run out. Bitcoin didn't promise 20%. Bitcoin promised nothing except scarcity and network survival. That's a far smaller promise. It's also the only promise the crypto market has ever consistently kept. The question that titles this video is not rhetorical. It's an invitation to ask a harder question than the one most people ask. Most people ask, should I invest in crypto? The harder question is, which part of crypto am I actually talking about? Because those are not the same market. Bitcoin is one thing. The thousands of altcoins, most of which will eventually fail, most of which will never recover their all-time highs, most of which are designed in ways that benefit insiders at the expense of retail buyers, are something else entirely. That doesn't mean every altcoin is worthless. A small number will survive. A smaller number will thrive. But in a market where more than half of all listed coins have already gone to zero, the odds are not in your favor without a framework for telling the difference. And most people don't have one. Not because they're unsophisticated, but because the framework doesn't fully exist yet. Zoe still holds her Bitcoin. She's not sure what it's worth. but she understands something now that she didn't understand before she lost money. There is a difference between an asset you can't value precisely and an asset you can't value at all. The first is just investing. The second is something else. Knowing which one you're holding is the most important question in crypto, and nobody selling you a coin wants you to ask it.